Derivatives trading involves substantial risk of loss, and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Thursday. We have a big day ahead of ourselves here. So in about 7 minutes time, we do have the continuing jobless claims. Then we have the ECB. Also, I am releasing a pretty big deal video. I think we're going to wait until the S&P 500 opens to talk about it. We'll watch the video here. So stick around. I promise this is going to be a big deal. You're going to want to stick around here on the stream to see what we do when the S&P 500 opens. It's going to be really probably one of the biggest events on this channel we've ever had. Okay, so stick with me here. Let's go through the charts here really quick. Oh yeah, let's turn on some music. I want to get some music in here. Am I showing you the right screen? I am. Okay. This has been switching on me a little bit lately because of OBS update, but I think that we got everything sorted out here. So shall we do lo-fi today? Let's do some lo-fi, okay? Turn that down. All right. Now I do have to roll some instruments over. I've already rolled them over here in NinjaTrader. I'm going to have to do that in Jigsaw. Okay, so when coming into the treasuries, yesterday there was quite a big reversal higher that I got caught up in, and now today even more. So I am not 100% sure what's going on, but one of the big drivers that kind of like keyed everything off was oil taking a huge plunge yesterday, and now just kind of middling. S&P 500 took a big rally as a result, and in the overnight they're just kind of going sideways here. Look at gold and silver. Gold and silver actually moved up there as well. And you know what, like, if this trend continues here in the treasuries, right, like let's say that was the low of the year. I don't think that was the low of the year. At least the Federal Reserve continues to be very aggressive against inflation and is likely to continue to be hawkish well beyond what is probably necessary. So that might not be the low of the year, but let's say that it is. That would be really positive for silver and gold, right? We also got copper moving up, so maybe things in China are clearing. I don't know. Bitcoin still kind of reeling from that big down move that they had earlier in the week, but they are recovering it, and they did not break into new lows, and the dollar is coming off of its highs. So what we've got here in the markets overall looks like a pretty constructive risk on market at the moment. Just note, the analysts are all very skeptical of this. Okay, so could flip on us very quickly. Okay, so I gotta come in here. I think I had my video scheduled for the wrong time, so I want to come in here and change that. Linus Tech Tips: get an iPhone 14 or die. Okay, so we'll put this out at 7:30. We'll watch the video here when it comes out, okay? By the way, For U.S. initial jobless claims, they are looking for a reading of 235,000 versus a previous reading of 232,000. I don't expect anything too big there, but then we will get the ECB. So we'll listen to that one that comes on. Oh, let's see here. I have to change something. Okay. Got that, got that. Your bearish Dolly says I'm bearish on gold and Euro USD and bullish on DXY for today. Well, it's a hard call for me here on the dollar. I mean, the ECB press conference is the thing. There has been, okay, so here's the non-farm, or here's the initial jobless claims, 222, so less than expected. Less than expected is pushing treasuries down a little bit. This is kind of an anything can happen kind of situation, I think, because there's a lot of volatility in here because of the ECB, but it doesn't appear as of yet have a clear direction. It is causing a lot of flattening in the treasury market though, so I'm gonna keep a close eye on that, but I think you're looking in the right spot. The dollar is going to be probably one of the big deciding factors today. And at the moment, it is going to the upside. Okay, so now the next thing is I do need to switch to ESZ. Should be ESZ2, right? Or it should be ESZ22. Not seeing that one though. Hold on a second. Maybe it's just ESZ2. That looks right. Maybe I need to pull up edge clear here for a second. No, it's still on you. No, I think that's right. Because that's ZBZ2. This light is in my, it's hard for it. ESZ2, ZBZ2, ZNZ2. Okay, so it is just 2. I don't know why I thought that these were 22. I guess I was seeing the Z as a 2 and thought that it was ES22 or something like that. All right, so we are seeing treasuries move to the downside after the initial jobless claims numbers. Yep. So that was just rolling the ES there. So I am looking at the liquidity there isn't super great yet, but we'll just leave it over there in ESC. Of course, the treasury is already rolled. Nick Demerose tweets, European Central Bank raised its target rate by 75 basis points. Thank you, Nick. I wouldn't have noticed. Let's see here, Brannigan Barrett, dovish ECB. Yes, they hiked 75 basis point, but they will continue reinvesting proceeds until 2024. There will be no quantitative tightening in Europe, and more than likely, the ECB will be in cutting cycle in 2024. Oh, I did not realize. Okay, that is perhaps why we have seen some net buying over the past few days. Was maybe they knew, maybe some people knew that's what was going to happen. Larry H. Summers, I am glad Chairman Powell and his colleagues are now being clear that they will do what is necessary to contain inflation. The more determined they appear, the lower will be the cost of reducing inflation. He is correct. Based on my reading of the history, how one of the big challenges is just convincing the public that they can and will tackle inflation. What's Brannigan Barrett saying here? That's hard to view this image that he's tweeting here. An update on U.S. inflation expectations when you're there. Now at 1.8%. They were at 2.5% at the start of September. Why does this matter? Because we have a repeat of 2018 all over again, where the Fed tightened too fast and was forced to pivot. So what is the place? And we'll start with the 2-year yields. In 2018, we had a similar trade setup. We ended yearly highs, then failed to break out, and that was the top for bond yields for cycle, looking for something similar. We recently broke above June 3.45 resistance, but have stalled. This isn't a typical technical breakout. Given the close below 3.45 yesterday, it's time to build a long position. Well, there's a little bit too much technical analysis in that, but the issue that I continue to see in the bonds is that the Federal Reserve is much more concerned about the inflation, right? So how much further do they have to go to really, so here's the thing. Way back in the day. Oh, by the way, we need to pull up the ECB here before I go into pontification. Back in the day, in the 70s, they had a very difficult time bringing inflation back, and part of it was because they raised and then they backed off too quickly, and so inflation came back. So they're probably going to err on the side of being too hawkish to ensure that inflation comes down. So for now, that seems to mean that they are going to raise interest rates 75 basis points in September. What does that mean about November, December? We're not sure yet. Okay, let's pull up. Do we have the press conference isn't going quite yet. Well, the volume in the treasuries is somewhat light at the moment. Still waiting for the ECB, and it looks like bonds are falling apart here. And where are yields at? 2.6. That really makes me want to get involved here. But I think that I'm remembering last time I did something like this during ECB press conference, I regretted it. So I'm not gonna do it. But I'm also wondering here, was the jobless claims that big of a deal? Because it looks like that's what really started when they started moving to the downside. I mean, I guess they were lower overall anyways, but it was like there was a little bit of middling there for about 10 minutes, and then they've started to drop here. What's this? Hot air is flagging something here this morning. Let's read this while we're waiting for the ECB. Here, I'll pull this over here. I will hide myself. Put him right there. Put Mrs. Laguard over here. Oh yeah, we need to keep that muted. Default view. Okay. Basic. There we go. Okay. And I'll read this story here. According to Washington Post, the most enthusiastic voting demo is not Democrat women angry over abortion. It's not independents unhappy with Donald Trump. If Philip Bump's analysis for the Washington Post is correct, the most enthusiastic demo in this cycle may have been broadly overlooked by prognosticators this summer because the most enthusiastic demo this fall is Republican men via David Strom, who will join us next week. On Tuesday, I looked at the growing murmurs that American women in particular are going to flood the polls in the wake of the Supreme Court's decision in Dobbs versus Jackson's Women's Health Organization. Protecting access to abortion in the wake of the dismantling of Roe v. Wade quickly became a rallying cry aimed at November. But polling doesn't indicate that Democrats have seen a big surge in support from female voters. In fact, data provided to the Washington Post from the polling firm YouGov indicate that the group that reports the most enthusiasm about voting is the polar opposite of what many expect, Republican men, and that this enthusiasm has grown. True, but hasn't enthusiasm grown faster among those demos tied more closely to the end of Roe? Question mark? One would think that if such trends existed, YouGov would find them, given their routinely sinister estimates of Joe Biden's approval rating among pollsters. The answer YouGov gives a bump, however, is a resounding no. Democrat women reported more enthusiasm after the decision was released in June, continuing an upward trend, but Democratic men expressed a much bigger surge in enthusiasm, one that was fairly short-lived. Republican women, meanwhile, didn't change their reported enthusiasm much following Dobbs, but more than half of Republican men now consistently report being more enthusiastic than in other years to vote in November. They're the only group above the mark. Their reported enthusiasm has also been trending upward. The patterns are more clear if we look at 4-week groups of reported enthusiasm. If we consider the polls before Dobbs, before immediately after, and the 4 most recent, you see that enthusiasm is pretty flat among independents and Republican women. For Republican men, their already high level of enthusiasm ticked upwards. For Democratic men and women, enthusiasm increased quite a bit post-Dobbs and then waned. So, where are we to make of the post-Dobbs media narratives? Either those outlets looked at different data sets than YouGov, or they caught up in a popular narrative without much evidence for it. It certainly seemed like the end of Roe would generate angry enthusiasm among abortion-favoring women, and YouGov confirms it did briefly. That was likely enough to fuel a few months of that narrative, at least until someone peeked under the hood. Yes, Kyle, the ECB rate hike was expected. Okay, here we're getting... Okay, that they're still getting up there. They're taking all of the pictures and stuff. Aren't they a little late? Don't they usually start this at? Well, whatever. Let's finish reading this. Why was that enthusiasm short-lived? As I wrote in late June, when a set of election results failed to demonstrate any actual voter response to Dobbs, it's because most Americans don't live and breathe abortion every day of their lives. They have to live and breathe issues like the economy and crime every single day, though. But even if it was a largely an abortion issue, it didn't move the needle enough to matter in Nebraska. That's just 4 days after the Dobbs decision made Roe revocation final. It didn't move the needle this week. It's highly unlikely to move the needle in November. This midterm cycle will still hinge on the economy, inflation especially, crime, and the referendum on the incumbent president. Okay, here's you talking now? Okay. So let's turn the music off.
As we are meeting in a hybrid format again, I would like to ask those who will then later ask questions via their camera to put on their microphones and their cameras, because we want to see and hear them. And now, give the floor to President Lagarde. President Lagarde, please.
Thank you very much, Wolfgang. and good afternoon to all of you, particularly those that I can see in the room. I hope you had a good break. So today, the Vice President and I welcome you to our press conference. The Governing Council today decided to raise the 3 key ECB interest rates by 75 basis points. This major step frontloads the transition from the prevailing highly accommodative level of policy rates towards levels that will ensure the timely return of inflation to our 2% medium-term target. Based on our current assessment, over the next several meetings, we expect to raise interest rates further to dampen demand and guard against the risk of a persistent upward shift in inflation expectations. We will regularly re-evaluate our policy path in light of incoming information and the evolving inflation outlook. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach. We took today's decision.
Well, a little bit of reversion here, but
interest rates further because inflation remains far too high and is likely to stay.
SEC's Gensler supports commodities regulator having Bitcoin oversight.
According to Eurostat's flash estimate, inflation reached 9.5% in August. Soaring inflation and food prices, demand pressures in some sectors owing to the reopening of the economy, and supply bottlenecks are still driving up inflation. Price pressures have continued to strengthen and broaden across the economy, and inflation may rise further in the near term. As the current drivers of inflation fade over time, and the normalization of our monetary policy works its way through the economy and price setting, inflation will come down.
It will come down.
ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 22, 5.5% in 23, and 2.3% in 24. After a rebound in the first half of 22, recent data point to a substantial slowdown in euro area economic growth, with the economy expected to stagnate later in the year and in the first quarter of 23. Very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they are still constraining economic activity. In addition, the adverse geopolitical situation, especially Russia's unjustified aggression towards Ukraine, is weighing on the confidence of businesses and consumers. This outlook is reflected in the latest staff projections for economic growth, which have been revised down markedly for the remainder of the current year and throughout 23. Staff now expects the economy to grow by 3.1% in 22, 0.9% in 23, and 1.9% in 24. The lasting vulnerabilities caused by the pandemic still pose a risk to the smooth transmission of our monetary policy. The Governing Council will therefore continue applying flexibility in reinvesting redemptions coming due in the Pandemic Emergency Purchase Programme portfolio.
It's a little bit of a pullback, but they're shoving back down very aggressively there.
To the pandemic. The decisions taken up
decent amount of volume too.
In a press release available on our website. A separate technical press release on the remuneration of government deposits will be published at 3:45. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy grew by 0.8% in the second quarter of 22, mainly owing to strong consumer spending on contact-intensive services as a result of the lifting of pandemic-related restrictions. Over the summer, as people traveled more, countries with large tourism sectors benefited especially. At the same time, businesses suffered from high energy costs and continued supply bottlenecks, although the latter have been gradually easing. While buoyant tourism has been supporting economic growth during the third quarter, we expect the economy to slow down substantially over the remainder of this year. There are four main reasons behind this. First, high inflation is dampening spending and production throughout the economy. And these headwinds are reinforced by gas supply disruptions. Second, the strong rebound in demand for services that came with the reopening of the economy will lose steam in the coming months. Third, the weakening in global demand, also in the context of tighter monetary policy in many major economies, and the worsening terms of trade will mean less support for the euro area economy. Fourth, uncertainty remains high and confidence is falling sharply. At the same time, the labour market has remained robust, supporting economic activity. Employment increased by more than 600,000 people in the second quarter of 2022, and the unemployment rate stood at a historical low of 6.6% in July. Total hours worked increased further by 0.6% in the second quarter of 2022 and have surpassed their pre-pandemic levels. Looking ahead, the slowing economy is likely to lead to some increase in the unemployment rate. Fiscal support measures to cushion the impact of higher energy prices should be temporary and targeted at the most vulnerable households and firms to limit the risk of fueling inflationary pressures, to enhance the efficiency of public spending, and to preserve debt sustainability. Structural policies should aim at raising the euro area's growth potential and supporting its resilience.
Euro does seem to be having strength here.
Inflation rose.
It's not looking too good for Dolly's
9.1%
long on
Energy price
the dollar
inflation
today.
remained extremely elevated.
but it's still early. I don't think we should read too much into this until the S&P 500 opens, yeah?
Component of overall inflation. Market-based indicators suggest that in the near term, oil prices will moderate, while wholesale gas prices will stay extraordinarily high. Food price inflation also rose in August to 10.6%, partly reflecting higher input costs related to energy, disruptions of trade in food commodities, and adverse weather conditions. While supply bottlenecks have been easing, these continue to gradually feed through to consumer prices and are putting upward pressure on inflation, as is recovering demand in the services sector. The depreciation of the euro has also added to the build-up of inflationary pressures. Price pressures are spreading across more and more sectors, in part owing to the impact of high energy costs across the whole economy. Accordingly, measures of underlying inflation remain at elevated levels, and the latest staff projections see inflation excluding food and energy reaching 3.9% in 22, 3.4% in 23, and 2.3% in 24. Resilient labour markets and some catch-up to compensate for higher inflation are likely to support growth in wages. At the same time, incoming data and recent wage agreements indicate that wage dynamics remain contained overall. Most measures of longer-term inflation expectations currently stand at around 2%, although recent above-target revisions to some indicators warrant continued monitoring. Let's turn to our risk assessment now. In the context of the slowing global economy, risks to growth are primarily on the downside, in particular in the near term.
You seem too confident to be credible. To be honest with you, Dolly.
The war in Ukraine remains a significant risk to growth, especially if firms and households faced rationing.
When somebody sounds that confident, I'm immediately like,
confidence could deteriorate.
well, you are right. Gold did get creamed, didn't it? But that's because interest rates are rising at the moment.
Energy and food costs could also remain persistently higher than expected. A further deterioration in the global economic outlook could be an additional drag on Europe.
I'm looking back at when we were at 2.6 and I was like, I'd really like to go long here, but I don't want to be long during the ECB press conference.
Are primarily on the upside. In the same way as for growth, the major risk in the short term is a further disruption of energy supplies. Over the medium term, inflation may turn out to be higher than expected because of a persistent worsening of the production capacity of the euro area economy, further increases in energy and food prices, a rise in inflation expectations above our targets, or higher than anticipated wage rises. However, if energy costs were to decline or demand were to weaken over the medium term, it would lower pressures on prices. Let's look at the financial and monetary conditions now. Market interest rates have increased in anticipation of further monetary policy normalization.
I mean, the euro has gotten weaker as she started speaking.
Credit to firms has become more expensive over recent months, and bank lending rates...
Not so sure I see what she said that would do that.
...more than 5 years. In terms of volumes, bank lending to firms has so far remained
Queen Elizabeth under medical
in part
supervision.
reflecting the need to finance high production costs and inventory building. Mortgage lending...
U.S. tells Israel nuclear deal with Iran is off the
because
table
of
for
tightening
now.
credit standards, rising borrowing costs, and weak consumer...
Well, the question is, why are you so confident in that?
Summing up, we raised the 3 key ECB interest rates by 75 basis points today and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period. This major step...
Well, that's an interesting take here. Zero Hedge is pointing out that
level of policy rates towards levels that will support a timely return of inflation to our 2% medium-term target.
U.S. continuing jobless claims hits 5-month highs.
Will continue to be data-dependent and follow a meeting-by-meeting approach. We stand ready to adjust
Oil's taking a jump here.
within our mandate to ensure that inflation returns to our medium-term inflation target. We are now ready to take your questions.
Thank you, Madam.
Is far? Oh, you're saying that they're far from getting into their target. Yeah.
News International.
Good afternoon, President Lagarde. 2 questions, if I may. The first, could you give us a flavour of the Governing Council's discussions, the arguments for and against that led to today's decision to raise rates by 75 basis points and not, for example, 50 or 100 basis points? And then my second question, from the present standpoint, how close to both the neutral rate of interest and the expected terminal rate does today's decision bring us in your...
Well, I think that is maybe expected because she has been saying things the whole conference that...
On your first question...
You know.
The Governing Council unanimously decided to raise the 3 key ECB rates by 75
I think the child is cooking food because I can smell it.
We had different views around the table, a thorough discussion, but the outcome of our discussions was a unanimous decision. So how did we come to that decision? As I have said before,
She's such a storyteller.
in that monetary policy statement, since our last July meeting, we are data dependent and operate meeting by meeting. This is the methodology that we adopt. So we were presented by staff with their projection. We had the inflation numbers and the growth outlook, of course. So in the face of these extremely high numbers, the last reading was 9.1 for a monthly reading. But if you look at the last 10 readings, they were the last 10 highest readings in turn. We had a good analysis of the decomposition of the sources of inflation, a good analysis of where the inflation actually lies and what products are particularly affected. And while we conclude, of course, that energy is still the major source of inflation, it's 38.3% compared with a year ago, slightly moving down in these August numbers. But it is still a dominant factor, as is the increase in food. But we also have an inflation that spreads across the whole range of products, in particular in the service sector, where supply factors are less prevalent and where demand plays a role. So we have a range of the product and services.
Kevin, are you on September still?
4%. So in the face of an inflation that is extremely high, that is
I'm gonna see what that
of
smell is.
magnitude and persistence across sectors of that nature, obviously determined action had to be taken. And this is very much in line with our determination to actually normalize monetary policy as we started back in December. So for those who consistently repeat that the European Central Bank is...
They definitely burned something. Hopefully the fire alarm doesn't go off.
That we are on a journey that started back in
The
December.
euro is getting creamed. It is, right here at least.
Put an end to the asset purchases under PEP and under APP, to move out of negative interest rates as we did back in July, and now to
The treasuries aren't
on our
moving too much,
normalization
though.
path with the front-loading exercise that we conducted today, because we believe that
It seems like a move isolated largely to the euro at the moment.
this front-loading. And we also decided that this was not an isolated decision, but that we would raise interest rates further. We didn't say that we would raise interest rates at 75% as if 75 was the norm. It is not.
What was it that she said there that they're reacting to, you think?
On the basis of data, how we reach to that level of interest, which will actually return us to the 2% target in the medium term. It is not there at the moment.
Oh, Chairman Powell is speaking.
At the end of December, which is not the medium term, but
That's
it's the
right.
end of our projection exercise, is at 2.3. We are not there.
He's no
So we
stranger to the
have
Fed.
more journey to cover going forward. But we had a very, you were interested in the flavor of the Governing Council. We had a very cordial, effective, deep discussion on all these.
Yeah, it could be.
And that certainly helped
I
us
agree with you here, Kyle. Like,
proposals by staff
she's just saying the obvious.
recommendation by our chief economist.
But the problem is that there's a lot of asset managers out there that don't seem to understand what is obvious to us that are more involved in the treasuries.
the rate, whether you call it
I'm seeing that more and more and more.
is different. But I would like to say this. What I know today is that 0 is not the neutral rate, and that where we are is not the neutral rate. We are heading in that direction. It takes a front loading. It will take further hikes in the next several meetings of a magnitude and at a
FX
pace
looks
that
says
will
I
be
smell big
determined
panic here. What is
meeting by
she saying?
meeting and on the basis of the data that we receive. But we are certainly heading there because that's where we believe that we will actually deliver.
They're pushing rates
on
up.
our 2% medium-term target as indicated in our strategy.
Thank you, President.
So they're now moving into overnight lows.
Thank you very much.
See, 025 is probably the bottom of this.
On quantitative tightening, because
So see if they go into the 01 half to 116 even area.
The system and help you to tame inflation. Have you discussed it? Is that something you are looking at? And then one question about your economic outlook, because clearly for 2023, you are seeing growth coming back to 0.9%, if I'm right. But this is still quite optimistic compared to other forecasts. So
That's 24.
24, yeah.
1.9.
Okay. Okay, but for next year, why don't you see a recession? Because many economists do see one. Thank you.
Let me start with the second one. So the baseline outlook is 3.1 for 22, 1.9 for 23, and sorry, see, I'm getting confused as well now. So back, 3.1 for 22, 0.9 for 23, and 1.9 for 24. So that's the baseline that we have in the projection by staff.
No, I don't think that it's that they're scared.
We also have, and I think you will be receiving those.
I don't want to talk over here and go on a big thing, but I think there's something really important that people are missing.
Used by staff on the basis of assumptions.
Surprise us.
Of risks in particular, some of which.
You talking to me or Christine?
And in those numbers, you will see that from memory.
Look at it, rebound here. That's a pretty hard rebound.
0.9 for 22 is at minus 0.9.
The ECB.
23, and at 1.9 again for 24. So while even in our baseline, we foresee some stagnation for the last quarter of 22 and the first quarter of 23, in the baseline, we don't forecast negative growth in 23. In the downside scenario, we do. That downside scenario differs from the current situation in that it includes, in particular, total shutdown of all Russian gas supply. Well, we're almost there. There's still a bit of flow going through the Ukrainian ones. But we also foresee rationing across the whole euro area and no measure of compensation between the shortage of gas supply and other alternative sources of.
It'd be better to say most projections say we are heading into recession.
Asia or other producers of gas, and in particular, I don't think we take into account the LNG that we could be sourcing from more of it from Norway or from the United States. So it's a really dark downside scenario, but it's one that concludes to a 23 recession. But it's the downside scenario, it's not the baseline. Okay. So on the issue of quantitative tightening,
so they rebounded hard, but then got sucked back down.
Present is the most effective, most proportionate, and most appropriate.
I'm not seeing like super heavy volume, but the pace of it is pretty consistent with a block order sell.
Policy rate in the next several meetings, as I have said. And of course, we will look at other monetary policy.
The spreads are also still flattening.
At this point in time, it is still premature, but it is a matter that we will, of course, debate amongst members of the Governing Council in due course.
The euro is interpreting everything as dovish.
Next question goes to.
I don't know, man.
Sorry, Iliana Rando.
It could have nothing to do with that, though, right?
Thank you. Good afternoon, Madame Lagarde. I have two questions as well. One, I want to ask you about inflation and interest rates. You've said inflation is far too high. do you expect, from today's perspective, and I appreciate it's a difficult thing to say, that the ECB will have to go into restrictive monetary policy to get a handle on inflation? And the second one relates to your mention of government deposits and how they are remunerated. The cap on government deposits has, along with collateral scarcity and high excess liquidity, led to a considerable divergence of short-term rates in markets. And I am curious what you decided on that, and how do you see the policy transmission improving as a result of your decision?
So do you see how those offers are stacking behind it pretty quickly?
To your first question, I think it's a process of normalization that we have started. As I said, beginning in December, out of negative territory in July, and moving with this front-loading step in our journey of normalization towards such rates that will be compatible.
Yeah, maybe recession fears are stronger than the hawkish tone she's already portraying, so the euro plummets regardless. Could be,
So
yeah.
for the moment, we normalize. Once we have reached that level of normalization, that will enable us.
I mean, the S&P 500 isn't looking too hot here, right?
Target of 2% in the medium term. Then we will examine what is the situation on the basis of data, on the basis
there they go below 116.
can contribute to the economy. So we will cross that bridge when we cross that bridge. For the moment, we are actively busy and engaged.
I'm having a hard time not participating in this.
And in making sure that we actually return to.
But I don't think I actually understand what's going on. They are trading 1,000 clips here at every price now, though, below 116 even.
We'll be getting a technical press release that
so liquidity's not pulling out of the way anymore.
Made in relation to the remuneration,
but there's
government
very strong sell volume.
My recollection is that we're moving from 0 to DFR, but I don't
very
want
scalpable
to sort of jumpstart, and I will let you just consult with great interest the technical decision that is embedded in the press release.
I think you got to be careful with that sort of play because, well, maybe yes, I don't know. You're in the treasuries. You got to be careful with this sort of play because, you know, as soon as you decide to jump on board that it's going to continue, it could be where it just completely retraces the move.
To this hike today, does the ECB have an objective of the on the euro exchange rate, since this would appear a way to lower the imports, to the cost of imports, especially energy ones? And second question about the TPI, you unveiled details in the last meeting, but nothing has appeared in the official journal. Can the TPI be used from now? And if not, why take time to implement it? Is there any question about who bear the financial risk of these operations? Thank you.
Thank you very much for your
She's French, right?
questions. It will not surprise you.
I liked her accent.
Of course, we do not target any kind of exchange rate.
Kevin says I'm not quite certain, but I think she is French. You're thinking the same thing I was.
Noted the depreciation of the euro relative to a basket of currencies, but more importantly, relative to the dollar. Just to give you a magnitude, an order of magnitude, it's over the last year 12% relative to the dollar and 4% as nominal effective.
What outlet was she from?
Relative to other currencies in general. So, of course, we notice. We know that it does have an impact on.
They didn't show her name or anything. Wait. Let's go back here.
Mrs. Lagarde, you told us that.
My recollection is that we're moving from 0 to DFR, but I don't want to sort of jumpstart, and I will let you just consult with great interest the technical decision that is embedded in the press release. Thank you.
Thank you, President. Next question goes to Ode Kersulek of BFM TV. Ode, please.
Thank you.
I understand a thing he said, so whatever. Did you hear what she said? Was that BFM Tel Aviv? Did she say BFM Tel Aviv? So does that mean that she's actually Israeli?
Unanimously has some criteria.
That actually might.
And some eligibility dimensions to them, has termination point too. And if and when the
I don't know, I'm not that good with identifying accents. I wouldn't consider myself an expert in that arena.
No question about it.
Thank you, President.
Yeah, J-Pow is speaking at the moment. I have that pulled up on the other screen.
Korani of Reuters has his hand raised. Balázs, the next question is for you.
Good afternoon, and thank you.
So the last headline I got here from Paolo, it is very important that inflation expectations remain well anchored.
Madam President, banks that have borrowed TLTRO money on the cheap now stand to benefit by depositing this with the ECB. And that sounds like gaming the system to me, but I know some colleagues...
BFM TV, not Tel Aviv. BFM TV. BFM is a 24-hour rolling news and weather channel based in France.
That could be happening in the future. What do you think about TLTROs? The second question is about the downside scenario in growth, because as you mentioned, some of these downside risks have materialized. So how deep a recession would you need to reconsider the policy rate path and say, now this recession is actually...
But I could not hear what her name was.
Is the downside scenario enough for this? Or would you...
And they don't put names on the screen, so...
On your first question, I remind you that the TLTRO changes of conditions that were introduced during the pandemic were engineered, designed, and intended to encourage banks to lend to the economy, which is what we all wanted, which is what was predominantly done. And the TLTRO pricing that was then designed was intended to that effect. Now, it's obvious that as we are shifting to positive territory in terms of interest rates, there are multiple dimensions of our operational frameworks, our remuneration mechanisms that need to be revisited. And this is a matter that we will take up, that will see some resolution. It has not been debated on the occasion of this particular monetary policy meeting, but it's an overall review that we will obviously conduct in due course. On your second question, look, we are in a situation where at zero interest rate, and even with this front-loading, we are...
I'm going to find her name. I'm going to stop paying attention and find her name.
Monetary policy. Now, doing that when we have 9.1% inflation and projected inflation at the end of our projection period north of our target at 2.3 simply does not warrant that accommodative monetary policy continue to stimulate. Our mission is to restore price stability, is to return inflation back to 2%. As a result of that, we are determined to do this job, and we will continue to make the decisions on the basis of data, meeting by meeting, and obviously, if we are faced with a major supply shock, if, for instance, gas prices were to continue to skyrocket, well, we will take that into account, both in terms of the consequences on growth, which will be recessionary, but also consequences on inflation.
No, I'm going through all their reporters now.
That work will be done in due course, as I said, meeting by meeting. Thank you.
Thank you, President. Next question is for Martin Arnold of the Financial Times. Martin, please.
Thank you very much. Could I ask a question about the terminal rate? Have you identified the terminal rate? Can you share that with us now? And could you also talk about whether the increments of interest rate rises will get smaller as you get closer to the expected terminal rate? Thank you.
What I can tell you for sure is that as we are so far away from the rate that will help us return inflation to 2%, our hikes have to be not only timely, but of a magnitude that brings us closer and more quickly towards those rates. Now, a contrario, am I saying here that as we get closer to those rates, the incremental interest rates increases will be smaller. No, I'm not saying that, because we will proceed meeting by meeting and on the basis of data. So I don't want to prejudge and to anticipate. What I can tell you is that the further away we are, the larger the step we are taking, which is why we are front-loading now. Do I know exactly what is the terminal rate? No. And this is a matter that is going to probably agitate debates, and everybody will have their view. But it's obviously one that we have to decide again as we get closer and as our forecast tell us whether or not we are reaching our goal, the 2% medium-term target inflation. This is what, on every occasion, will help us define or not whether we are at that particular rate.
Thank you, President Lagarde. The next question is for Jan Malin of Handelsblatt. Jan, please.
Good afternoon, Madame Lagarde. I have one additional question on quantitative tightening. Would it be possible for the ECB to end its reinvestments in the APP program in the near future? Because, yeah, the Bank of England, the Fed have initiated QT already for some time. And my second question is on the forecasts. The ECB has underestimated inflation for some time. So how relevant are they still for monetary policy? Thank you.
Well, thank you very much. You remember that last July, we decided to no longer rely on forward guidance on many aspects and to work meeting by meeting on the basis of data, with the exception of the reinvestment program on APP and PEP, for which we still have some forward guidance. So the forward guidance that we have on APP
well,
is that,
since that initial kind of like push lower, they've kind of been moving sideways a little bit. So it looks to me like whatever block selling that was going on in the treasury market at least, well, and it looks like the dollar as well has abated for now.
For PEP, it's not exactly the same forward guidance, but we also have forward guidance, and we refer to at least the end of 24 without interfering with our monetary policy stance. Having said that, what we are doing now is focusing and giving priority to the policy rate, because we believe that it is the most appropriate, most proportionate, most efficient instrument that we can use in order to return inflation to the 2% medium-term target. We, of course, examine all instruments, and the reinvestment policies that we deploy is part of the instrument. But now is not the time, and we would regard it as premature if it was to begin now. We are using the policy rate. It will happen. But on the basis of data, on the basis of our analysis meeting by meeting, and once we have determined that these policies of reinvestment or discontinuing reinvestment are going to be necessary and appropriate to help us return to the 2% medium-term target. You had a second question, if I recall.
Underestimation of inflation.
Oh, yeah. Yeah. Look, this is a matter which has been raised by many. Can we trust forecast? Can we trust the provisions? Can we work on the basis of...
So reversing...
by our economists? And we were as blunt as...
I'm seeing everything
why
kind of reverse here, in fact.
Came from. Because, yes, we made forecasting errors, as did all the international institutions, as did most of the economists.
So stick with me here afterwards. We'll figure out who that was. So I want to hear them speak more. And then I've got a really big deal video to show you guys. You're going to want to stick around.
So yes, we made those errors.
Reversing for the equities open? Maybe, yeah, look at how
You
hard
go
that's
under the
coming back,
surface
though.
and try to find what is the origin of those
If I
errors.
had gotten in at 2.6 where I wanted to, we would be safe, but probably would have been good for me to have taken profits, at least for
I
the
take
scalp,
blame
right?
Because I'm the head of the institution. And yes, we made forecasting errors, but those errors were made by all forecasters. Very different from them.
That's not too confidence inspiring, Christine.
We came forward with the causes for the errors, and I can assure you that staff constantly improves, tries to embed in the models what should be embedded, which was not up until now, and that we also apply as much judgment as possible to be as accurate as we can. But it is a fact that because these matters could not be anticipated, we have had to revise our projections. Absolutely.
Thank you. Thank you, President Lagarde. Next question is for Isabella Bufacchi of Il Sole.
So are they going to go later than they usually do? Because usually they want to be done by when the S&P 500 opens. But I don't remember last time that's not what happened, right?
On financing conditions. As you said, they are getting less favorable for households and firms.
The choice of lens for this camera that they use to look at the audience is interesting to me.
And I link
It looks like it's a pretty
financing conditions,
good zoom lens.
and the terminal rate, because the terminal rate is
No, that is true, Kyle. Almost every, well, not almost, basically every projection that's put out there about inflation has continually had to move their projections higher, even the ones that were at the top end of the range.
Conditions are going to get, tighter and tighter. Thank you.
And this is including like from all of the banks and so forth.
We took the decision today that we would continue to raise interest rates.
Wish I could find the chart again, but there was this one chart that was like all of the banks, and this was what their projection was, and this is what actually happened. And it's kind of a funny chart.
Meeting by meeting on the basis of data, because we believe that we are far away.
Because basically it's like they all saw that inflation was coming, but inflation was much higher than any of them expected. And it went longer than any of them expected.
Medium-term target. This is the goal that we have. You know, I'm not sort of scratching my head around the neutral rate versus the terminal rate versus the R star and so on.
Yeah, her excuse for failing is everyone failed. Correct.
That we want to get to that 2% medium-term target. And we will take the necessary steps along the way in order to get there. We think that it will take several meetings. Some people will say, how many is several? Well, it's probably...
Here's the S&P 500 opening up.
But it's probably also going to be less than 5. Now, I leave it to you to decide whether it's going to be 2, 3, or 4. You have at least a ballpark idea of how long it will take. That's the length of the journey. And this is the reference that we make to timely. You know, we want to return timely to that goal that we have. Now, you've asked me if the tightening in the bond market is going too far or not. It's not a bad anticipation that they've done, I would say. I'm not sure it's perfectly accurate, but it's not a bad market assumption.
Thank you, President Lagarde.
In current conditions.
The next question goes to Eva Wissing of the Dutch broadcaster NOS.
Thank you for taking my question. In the Netherlands, we experience one of the highest inflation within the Eurozone. For years, the ECB has been trying to bring up low inflation. What makes you so confident that you can now really bring back down high inflation? What perspective can you give to our citizens?
Well, look, first of all, the Netherlands is in the region of the high inflation countries, but it's not the highest. There are further and higher interest rates, particularly up north and in the Baltic countries. So we are very aware of the heterogeneity that we have between, say, Malta and France and the Netherlands and Latvia, for instance. And we have to care about all citizens of the euro area. I think for many years, what my predecessors have tried to do is to make sure that we didn't go into deflation territory. And
I've got it queued up here, so afterwards we can try and hear the name.
Quantitative easing.
But I can't do it while they're still talking, right?
The situation has significantly changed in the last 12 months. And, you know, I'm not trying to make a fine point or be cute about it, but we haven't tried for years to reduce inflation. Inflation is a phenomenon that we are facing and have been facing for the last 12 months or so. So we are now on that path of normalization of monetary policy. So we are exiting that period of quantitative easing and negative rates. That is behind us. We are now moving into positive territory.
By the way, is the Fed chairman still going? Yes.
And we are determined to return to the 2% medium-term target that we have under our strategy review and as a common denominator within the Governing Council. And we will take the steps that are needed to that effect.
Is it easier to bring inflation down than to bring it up?
Future will tell. But what I can assure you is that we are determined to do so. Inflation is a terrible phenomenon, in particular for the less privileged people. I think we are all aware of that. Our job is to return inflation to 2%, and we will deliver on that job. We should not expect, and nobody should expect, that inflation is going to return to 2% in the next 3 months. Why? Because there is a lag time between the time when we make the decisions and when it actually translates through the transmission channel to the real economy, so to speak. And also because it is still predominantly a supply-driven phenomenon. I cannot reduce the price of energy. I cannot convince the big player of this world to reduce gas prices. I cannot reform the electricity market. And I'm very pleased to see that the Commission, the European Commission, is considering steps to that effect, because monetary policy is not going
Powell said, I am prepared to adjust the balance sheet runoff as the economy needs. Fed independence serves the public well.
It will give a strong signal to people.
Could be that this reversal has more to do with what Powell is doing.
To reducing inflation. But if the cause is predominantly surplus driven and based on energy prices that keep rocketing, this is for somebody else to do the job. But we will do ours. We will do our job.
And the next question goes to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Thanks a lot. Good afternoon, Madame la Présidente. On interest rates, is the ECB ready to raise the rates above the terminal rate if it is necessary to bring back inflation to 2%, to force it? Because, and then bring it back to the terminal rate, what level it is. So this is maybe one question on guidance, if you can give us. And you said this, that provision is very something difficult in the ECB and other areas. So is in monetary policy now for this period something has more to do with artistic than arts than with science? You outlined this in a previous speech. So what is artistic in the decisions made today? Thank you.
Merci. As I said earlier, we start from zero. We're taking a major step by front-loading, and we know that we have more steps to go towards that, that rate at which we believe that we will return inflation to 2% in the medium term. If it means that we have to go further than whatever rate you refer to, we will do so. Okay? Because we have a goal, we have a mission, we have incredibly high inflation numbers. We are not on target in our forecast, and we have to take action. We don't want to see second round effect. We want all economic actors to understand that the ECB is serious about returning inflation back to 2% in whatever decisions they make. Now, you asked me about the artistic side. I wish it was artistic. What I meant is that, and I think I was quoting another famous, not that I'm famous, but a famous central banker who said that it was not just about science, but there was also an element of art about it. I think what I understand that to be is that
Treasury's completely retraced that move, and they're back to 2.6.
we cannot be exclusively driven by the outcome of models, however sophisticated they are, however judgment we put into the selection of assumptions that we make. We also have to include in those decisions
Who looks nervous, LaGuard?
collective judgment that we try to bring to the table in the course of those discussions. So that's what I meant.
Thank you, President Lagarde. Turning back to WebEx, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Tom, where are you?
Thanks so much for taking my question, President Lagarde.
Pleasure.
So yeah, I had two questions. As you've been speaking, the euro has been falling, and I suppose my question revolves around the likelihood of another three-quarter interest rate hike at the upcoming meetings. You've said that's not the norm, but will 0.75 percentage point be on the table going forward? And my second question was on the contrast between what's happening in the US economy and what's happening in the Eurozone. You've previously emphasized that the Eurozone is in a different place from the US. The Eurozone inflation rate is now above the US level. Does that mean actually they're in a kind of quite a similar situation when it comes to inflation, and the medicine needed is similar? Thank you.
Thank you very much. On your first question, what I'm saying is that we are not on a set course other than be driven by our goal. So our decisions will be made meeting by meetings, will be data dependent, be state dependent. And what I'm trying to explain is that we're not trying to mimic any other central bank. We are not transforming a front-loading exercise into a permanent exercise. But if the data on our meeting-by-meeting exercise review suggests that we should take a high hike of our interest rates, we will do so. So it is not preset, it is not predetermined, and it will be decided on a meeting-by-meeting. But the certainty is that we are far away from the goal. We are taking a major step today by front-loading, and we will decide more interest rate hikes in the future over the next several meetings. Your second question.
Contrast Eurozone. US.
Oh. I think you know the answer to the question, but I'm happy to repeat it. If you compare the situation of the US and that of Europe, and in particular in relation to inflation, inflation in the United States is
Running back down.
driven by demand. In the euro area, it is largely driven by supply. Not exclusively, there's also a portion of demand in the source of inflation, but it's predominantly supply. When you look at the labor market, which is an important phenomenon to appreciate, whether we
I think that's true, but I think I would like to see more evidence of that.
Inflation and second round effect in particular, we see a US market which is, some of you say it actually, red hot, where the rate of vacancy to unemployed person is 3 to 1, whereas here in the euro area at large, it's 0.3 to 1. So for one vacancy, we have 3 unemployed people. It's a slightly different situation. Third difference is that clearly in their normalization path and possibly tightening path, the Fed is starting from a different base from that of the euro. We were starting from negative territory, moving out of it, and going further on that normalization path. I think there are multiple other differences that I could give you, but I think those are the ones that will matter most for your analysis of the difference in inflation situation that we have.
Thank you, President Lagarde. And the last question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Madame Lagarde. In December, you were saying it was unlikely that rates will hike this year. In June, you were saying that in July it will increase by 25 basis points and it went up by 50 basis points. Now you need to front load now. Obviously, as you said earlier, you couldn't forecast the war in Ukraine. You couldn't forecast the
Fed's Powell, something that purports to be money ought to be regulated. Yes.
About the credibility of the ECB, because every time you need to basically accelerate. And the second question, if I can come back on the exchange rate, obviously you've said it several times, you are not targeting a level, but can you elaborate on the effect that the exchange rate has on the current economic climate here in the Eurozone?
It's a push higher. So almost back to where we were when Lagarde started speaking, at least in the treasuries. The dollar is coming back down too, though.
Need to accelerate. What I can tell you is that at this point in time, with the numbers that we have, with the dynamics that we see, with the sources of inflation, with the forecast that we have, we are determined to move, and to move at this timely pace that is referred to in the monetary policy statement, which means that as we are deviating from target, and with the high numbers that we have currently, we need to front load as we have this time around, and we need to continue hiking. That's our determination. Yes, we had to accelerate because when you are faced with new data, with new analysis, with new forecast, you of course have to adjust. And I think that our credibility will be judged by whether or not we return inflation to the 2% medium-term target as we are committed to. On the second one of the impact of the depreciation of the euro in effective term and relative to the dollar, I don't have a decomposition right now of how much exactly it contributes to the inflation as it stands, but it will be available in the documentation that will be published later on. Suffice to say that indeed it has a direct impact on our imports in particular, to the extent that most of the energy products are issued and denominated in US dollars.
Thank you, President Lagarde. This brings our press conference to an end. Thank you very much.
Okay, I'm turn the music back on here. So here's the thing that I think you got to understand to interpret a lot of what is going on with central banking, right? Is if you go back into the history, back in the 70s, you have to remember that inflation had been going on for a very, very long time. In fact, the Powell was just saying this, and Nick Timiraos was highlighting it. The public had really come to think of higher inflation as the norm and to expect it to continue, and that's what made it so hard to get inflation down in that case. And Nick Timiraos has commented on it, is Volcker had to deal with inflation that had built up over many years. So kind of the thing that happened back then was that they started to realize that inflation was not just like a central bank thing. I think that people had previously thought that, well, you get inflation and you raise the interest rates and you take care of it, and central bank policy has complete control over this. And what happened was they started to realize that people's expectations play a really big factor into it. There's a lot of lag, and so it's not a purely quantitative thing, right? And the real challenge back then was that they really had to convince the public that, yes, we can tackle inflation and we will. We do have the resolve to do it. And they had a very, very difficult time, and went on for years and years, of actually convincing the public of that, up until Volcker really came in and was like, all right, fine, I'm going to raise rates a whole percentage point. Like, we're going to do whatever it takes until you guys start to take us seriously, right? So make no mistake, these central banks, they talk to each other. They have like a meeting like every month, okay? And I'm telling you, mid-July, they had their meeting, and you could kind of see how all of a sudden all of the central banks were kind of like together with each other and saying the same sort of thing. And I'm telling you what happened there was they said, you know, we need to provide a unified front that we can and will tackle inflation. So that's what the central banks are concerned about right now. The market is concerned about the market that we're going to decline and then we're going to have a recession. And that was a thing in the 70s, was like there was going to be a recession, so then they'd back off and then inflation would come back, and it went over and over and over again. So that's why the central banks have kind of been ignoring all of that and saying, no, our responsibility is to get inflation under control, right? So the more that the market pushes back, the more that the market says, they're not actually going to continue to raise rates. They can't because the economy is going to go into a recession. Every time that happens and the treasuries rally because of that, that makes financial conditions easier and works against them. And this is exactly what the central banks are fighting against. So the more that the market pushes in that direction, the more I think you're going to see the central banks push back on it. But the ECB has a different problem, and that is this whole thing that going on with Russia and problems that we're going to have going into the winter. And so Lagarde in particular has to walk a really, really tight line because they do have to get inflation under control, but it looks highly certain that the euro area is going to go into a recession, even though she can't outright say that. And that's what all the reports. So I think that that's kind of why you're getting this back and, you know, some of these things, like she looks nervous. I think she's just really concerned about putting out the right messaging. She's more of a storyteller, media kind of person than a central banker. And, you know, the problem is that people think that they're not going to have the resolve, right? Because that's always been the problem, is that kind of the incentives of the system have ever since the Great Depression, all of the incentives in the system have basically trended towards more government involvement and easier money policy, right? And what the politicians are doing is very, very often works against what the central banks are trying to do to keep, you know, price stability. So I'm not sure why. Now, I can't explain all of the moves that we got. I'm not quite sure why the euro got crushed and the dollar rallied through most of her speech and then reversed. We did have Powell speaking at the same time, though, and he did say some things that would normally be market moving, although it doesn't seem like it's anything surprising to me. So let's just kind of let them battle it out here. But now I got something to show you. So I want to show you my new video. Oh, actually, no, let's find out what that lady's name was. I'm gonna play it back slow so that I can try and hear her name.
Mrs. Lagarde, you told us
to sort of jumpstart, and I will let you just consult with great interest the technical decision that is embedded in the press release. Thank you.
Thank you, President. Next question goes to Aude Kersulek of BFM TV. Aude, please.
Thank you.
Aude Kersulek? I don't see her name on any of these things. Oh, you do shift and the carrots or angle brackets. Shift angle brackets. Was it Arielle Casse? I heard a C. That's the only one on their list of reporters on Wikipedia. That's not her. I don't know what it was. I'm gonna have to spend later today trying to figure out what it is. If you guys figure it out, you let me know. But let's come back now and I'll show you this video, okay? How is Babby formed? Well, wouldn't you like to know? Okay, here we go. Yes, you read that right. DXFeed gave me the chance to watch full depth of market data for stocks, and it's a total game changer. Let me show you why. One of my specialties is reading order flow. The research is abundantly clear that it's orders that really move markets. So looking at price alone is simply insufficient to really understand what is going on. That means analyzing every market and limit order that gets placed in a market. Now, in order to do this form of analysis, you need to be able to see something called the order book or depth of market, more commonly called the DOM. The order book keeps track of all limit orders placed on the exchange. Those limit orders wait in line to get filled by being matched up with market orders. Now, this data allows us to do all sorts of useful things. For instance, we can categorize whether a market order was a buy or a sell by comparing the price that order executed at compared to the current best bid ask from the order book. Now, there's all sorts of great things you can do with order flow, and if you want to learn more about that, I have a whole playlist to teach you how to use order flow. Anyways, I typically trade futures because the full depth of market data is much easier to come by for futures. Almost every major futures trading platform these days comes with tools to help you read the order flow. Such data is not as common in stocks. There's been a few ways to get a hold of such data, but they haven't really picked up traction. Well, the wait is over, and I really think this is going to become a more common thing. Our friends at DXFeed have implemented NASDAQ's Total View, which allows them to provide full order book data for US stocks. The data is available in my favorite charting platform, NinjaTrader 8, as well as 9 other platforms. So when they offered me a chance to give things a test drive before the launch of the product, I jumped at the chance. Now, getting the setup working in NinjaTrader is pretty simple. You simply download and install their add-on that works with any version of NinjaTrader. Yes, even the free version of NinjaTrader, so you don't need an expensive license to do this. The free version of NinjaTrader doesn't let you submit live orders, but since DXFeed is data only with no execution, that's perfectly fine. So you can do your charting and data in NinjaTrader and use your regular stockbroker tools to actually submit orders. NinjaTrader's built-in DOM does not support stocks, so DXFeed created 3 new windows. The first window allows you to search for stocks so that you can add them to a quick list. You can then pull up stocks in their DOM and heat map windows. Both of these components are pretty standard affairs for those of you that are already familiar with order flow. Their DOM has a row for each price and displays how many limit orders are at each level. The heat map shows this data, but more visually, using colors and showing you how the market depth has changed over time. And again, even the fancy heat map works regardless of what NinjaTrader license you have. That's a really good deal because some vendors are charging a ton for market depth heat maps. Now, what DXFeed has is admittedly pretty basic, but it does work very well out of the box. Believe me, I poked around quite a bit trying to break things, and I wasn't able to find any problems. But here's the thing. It's on NinjaTrader, so I can still pull up a regular NinjaTrader 8 chart and use all of my favorite fancy tool. That includes tick replay based order flow indicators. I did find a few indicators that I had to fiddle with on historical data, but everything worked perfectly with live data, and that includes my elite order flow indicators that you can buy through speculatorseth.com. Now, one issue I did run into was that many order flow indicators don't deal with orders that occur in between the best bid ask. In futures, the spread is almost always equal to the minimum tick size, so they never encounter this situation, but in stocks, there's often more of a spread. So that means that you're more likely to run into situations where you need a more fancy algorithm to classify volume as buy or sell. So I worked really hard last week and created a version of cumulative delta for stocks that utilizes this more advanced trade classification algorithm to deal with those orders. It's only like 10% of orders, so it's not a huge deal, but this method is more accurate. I'll include it in my elite indicator suite at speculatorseth.com, and remember that you can try my indicators free for 2 weeks. There's a bunch of new things in there too, so if you've already done the trial and want to try again, just message me your NinjaTrader machine ID on Discord and I will reset your trial. I haven't even gotten to the best part though. It works with Jigsaw Bridge. So Jigsaw Day Trader is my favorite DOM and it's my primary trading tool. I am a Jigsaw affiliate, so you can get $100 off Jigsaw with my coupon code in the video description below. Now, Jigsaw has a feature that allows you to pipe data out of NinjaTrader and into Jigsaw. So I can use my favorite DOM with the current trades columns to tell me how many market orders it took to lift price. It's just an absolute dream. Like, really, I did not expect everything to work so perfectly. When I told Peter Davies from Jigsaw about it, he didn't seem too surprised though. So that kind of makes me wonder what things he might be up to. But the real question, is the data actually useful for stocks? I believe so. In fact, in some instances, I think this data will be even more useful in stocks than it was in futures. It's easier to find an instrument that's really moving where order flow reading will be more effective. So I really believe we're about to see a renaissance in stock trading here as more people learn about order flow. I think you'll agree once you see the recorded footage I'm about to show you. Like, I'm always a little careful about overhyping things, but really, I'm about to show you the coolest order flow you might ever see. I have an example of this data in action on none other than Bed Bath & Beyond at the height of the mania on the 17th of August. Yeah, check this out. So here I just happened to take a little sim trade long. You can see very aggressive and impulsive market orders coming in and taking out large chunks of liquidity all at once. Things get a little exciting, but what's this? Limit orders aren't really getting out of the way. Massive absorption here at the top and huge liquidity holes underneath. That's a big nope for me, so I took profits and sure enough, we quickly fell back down. You can see with my cumulative delta on the chart that even though price was slightly rising, we weren't really getting a strong, consistent flow of buyers. There was a lot more market selling than you might realize from just looking at price. It seems to me like sellers were more than happy to dump their bags on people, and sure enough, things got ugly with selling into the close, and the stock has struggled ever since. Order flow is rarely that clear, but I really think that retail traders might have behaved differently if they could see the data that I was looking at. That's not to say that order flow is everything. It only tells you about the current state of the market. You still need to understand the context around the moves for the day and have information that can reliably predict future orders. So reading the current market state through order flow is only part of a complete strategy and does not guarantee you success. Still, it's a very powerful tool that I cannot trade without, and I really think stock traders have a great opportunity to use it to their advantage, especially here early when few stock traders know about the advantages that order flow analysis can bring. Now, price, the data is $70 a month, and they did give me a coupon code, so if you use the link before the end of September 2022, you'll get 30% off, making your first month $48. So check the video description for that. I also want to note that it's not an affiliate link or anything. This is not a sponsored video, so I did not receive compensation to review this. They did give me very early access though, and I really enjoyed working together with DXFeed to make this video. We got into the real nitty gritty of this data and like every little update that it sends into NinjaTrader. They were very knowledgeable and I had a blast making this video. So, what do you guys think? Should I start watching stocks now? I mean, I love trading the treasuries and I'm definitely not going to stop doing that, but we could at least start watching some stocks. Let me know what you think in the comments. I will see you guys during the morning live streams every morning starting at 8:30 Eastern time. In the meantime, oh yeah, that's right. We're going to start a new outro. Stay excellent, team.
Okay, so I was trying to pull it up here. Okay, so here's the wife to take the baby.
He's a heavy baby, is what he is. Okay, let's see if I can get this to pop up here correctly now. Oh, you know what? I have to add the yeah. That's right. So first thing is that I have to add an instrument. So I'm gonna come in here, AAPL. I'm gonna add Apple DX feed to this list. Actually, let's add it to a different one. We'll open up a new market analyzer, is it? Yeah. New market analyzer. Add the column with the indicator. Coming in here and using the JT connection. Everything else here we can probably just remove. Okay. Add instruments, Apple. Okay. Then if I come over here to open up a DOM, come to platform, NinjaTrader 8. Okay. So now you got a jigsaw DOM with Apple. Huh? Is that not awesome? TLT, you want to watch TLT? That's a good call. Actually, that'll be interesting. Let's do that. Actually, so to do that, I need to add it into, so I need to go into their DX feed connector first. Load, find TLT. That's an ETF. That's it right there. Yep. Okay. I'll just minimize that. I'll add instruments in here. Okay. And now we'll load it up in Jigsaw. Now let's come in here and change these a little bit. We don't need that order column. Come on. My system is chugging along a little bit here today. There we go. There's TLT. So what else do we got going on? Let's come over to, well, first I got to figure out, that seems like I got something going on that's being a little, let's check my CPU here, because I think that I had so many Explorer windows open that was, no, that's weird. I don't know what is running these console window hosts that are taking up a lot of space. Try JPST. What's that? What the heck is that? Okay, let's pull it up here. So we come over here. JPST. Okay, it's an ETF. Need to change this so that the default is, let's see here. Come on. Come on, Ninja Trader. You can do it. That one is not as active, it looks like. How can I have a guaranteed stop execution? It seems to open up a position stop free, although I set up a stop sometimes. It is inconsistent when the stop is too close. I don't know what you mean by that. That JPSD one doesn't seem to be coming through. That's it right there. It may be that there's just hasn't been any volume come through it yet. Let's just try loading a stock chart for it. See if that works. Okay. So it's listed on Arca if that helps. Oops, did I just close the window again? Yeah, it says Arca. Well, it says it's on a bunch of them. It says it's on bats too. But when I pull it up on a 1 minute, it doesn't show me any volume for today. Is it just not a very active ETF then? Let me try pulling it up on TradingView. Oh, it's JP Morgan's overnight rates. That might explain why it's not really. Ultra short income in ETF. I don't know. So the data comes through NASDAQ Total View. So I'm going to guess that because the main exchange that it's traded on is Arca, and there's not very much volume coming through it on NASDAQ, that's why we don't see very much. Look, now that the trade has gone through on reported on the NASDAQ, we can see the depth, and there is a lot. That is a thick boy. Oh man, actually, I know why you said to bring that one up now. That's a thick boy. Well, TLT is not too bad. Apple is good. I got to tell you, I wonder if you want to just trade SPOOs, right? It may be worth it to have this just to watch the order flow in Apple and trade Apple together with ES. I think that one might make sense. Does it make sense for $70 a month? Yeah, I guess you'll have to try it out and see. But I'm pretty pumped about this. Did I come through? I said it would be a big deal. It is a big deal, yeah? Let's change the title of our thing here. Change the title of the stream here a bit. Okay. So interesting push through a big order there at 154.50 in Apple, and a little bit of pushback on it. Is this lots data 100s? I mean, for every one limit buy showing on the depth, that represents 100 stocks. No, I think it's 1-to-1. The downfall of this software is Sigma. Are you referring to that, like, we give everybody this data and then everybody else improves and then it doesn't necessarily provide an advantage, right? Here's the thing. I still think that ultimately, to really be profitable in trading, you need to have something that will predict future orders, which generally means that you have a piece of informational content not generated on the exchange that not everybody has. Right? Oh, you're talking about the black pool? Well, okay, so we can talk about that in a second too. So anyways, the thing is though, is that if you can't see the order book, you really can't understand what the market is actually even doing, right? And so that would makes it impossible for you to come in and say, okay, I do have a piece of information, but is the market acting the way that it should if there were other people waiting out there or trying to execute a block trade based on the same premise and so forth, right? You have to be able to see the order flow. Otherwise, you just don't understand what's going on. So this is a very important part of a complete strategy, right? It's not necessarily the key edge, but it's a necessary part, I think, if you're going to day trade. I think that trying to day trade off of just a stock chart, very, very difficult to do. Okay, now black pools. So here's the thing that I have found with the black pool is that the volume that occurs in the black pool eventually makes it to the rest of the market. So I'm not saying that the volume in the black pool gets reported at the end of the day and all of that stuff, although that is true and you can kind of go and look at it. But rather what happens is, say I am a large hedge fund and I want to dump a huge portion of Apple stock, right? So I go into the black pool and I'm able to do a block sell with my huge tranche of Apple stock, right? Who am I selling it to? Well, those are going to be like block trading firms that are then going to turn around and sell that volume on the actual exchanges. So the reality is that that volume eventually trickles down into the actual stock markets, the NASDAQ and so forth. It's not going to happen right away. So that means that what we're looking for in the order flow is you're still going to be able to get despite the black pool, which is, seeing the confirming order flow that helps you understand what the market is really actually doing. To Kyle's question again, it's not hundreds. I think that it really is just one lot per one share of stock, as far as I've seen. And yeah, you see, I have it to the minimum tick size of 1 cent. There's all sorts of really interesting things that I've seen. So one thing that I've found is that you can actually get market orders that execute at sub-cent increments. So you can have something come through at 155.01 half. and they're actually somewhat frequent. So apparently they can hit in at a sub-cent interval and like trigger hidden liquidity or stuff on a black pool, right? Black pools are just automated big block order requests. I mean, in the pit era, is a big fund needed to trade lots of stock. They called the banks, and the pit guy went there screaming all over. Yeah, that's exactly what it is. So it's like a way for them to sell it to somebody without anybody knowing, and then having the block firms turn around and sell it for them. But it ultimately it almost always gets to the exchange in one form or another. If it didn't, then it would just be irrelevant, because it was like both sides came together. One person wanted to buy, one person wanted to sell. What does that tell you? Right? What we're interested in the order flow in particular is that the market orders and the direction of the market orders is the best indication that we have of informed trading, right? Strong, highly directed order flow over a persistent period of time is highly indicative of informed trading. Not always, but it is the best that we've got, right? So if two big guys did one big transaction in one spot, does that really tell you anything about the informed content? Because they equalize each other out, right? If they traded a huge tranche in all one spot. But what we want to see is a persistent order flow selling and moving the market down. So I do not think that dark pools makes order flow reading less useful. And in fact, from what I've seen so far, I would argue that the order flow is more useful in the stocks than it is in the futures. It seems that informed order flow coming in is really, really important, and you get more sensitive moves to things. Like I showed in that video, it was like there was absorption against this really huge rush of retail traders buying in, and it completely flipped things around. And then you get, oh, we should turn the music on, by the way. And you get a little hole underneath you. It sucks you right back in real quick. And you can see it quite clearly when you're watching the DOM, where there will be like a really fast move up, perhaps. Not so common in Apple, but maybe some other stocks. And then the bids don't bid up behind it. And so it just falls back down. Like there will be like a bunch of places where there's just no volume at all. Like when you think about it, when you consider that Apple is like the biggest stock on the stock exchange, basically, and then most ticks only have one on the inside, at least sometimes 100 lots on them. That's not actually that much. In the larger scheme of things, that's not actually that much. The amount of money that it takes to move a stock is a lot less than retail traders think it is, right? Well, there was some that just traded in JPSD. Now remember, this is NASDAQ total feed is basically the main source of this data. So, you know, some of these, when they're, I don't know how the exchanges share the data, but I think that in this case, this product trades primarily on ARCA. So this would be a lot more useful. It's funny that all of the stocks that you guys wanted to look at were ETFs. You don't want to look at stocks? It does look like things have calmed down a little bit too. Let's come over here to Yahoo Finance. What's the most active stocks today? So for notional value purposes in the Apple full depth of market data, you're showing if there's 1,000 lots sitting at 155 and there was a single guy that put that order in there, he's trading 1,000 times 155 equals 155K. Correct. Oh, you want to see the heat map too? Yeah, we should. Well, so the thing is, so I'll show you their heat map. I'll just compare. So I think that their heat map has some work. I'll do it here in Apple. So here's the heat map that you get. You can kind of zoom it out here. And then I forget what you push to zoom in and out. I think it's, yeah, it's this. So you can zoom out. So I'll try and zoom out as far as it'll let me. Right, but it's just a little bit too fast to really pick anything out of it. If I come over here into this one and I open up Jigsaw's heat map though. It's a little bit better. I really like this heat map on something that's got a little bit more of a spread. Like AMD probably. Let's see. AMD might. Nvidia might. I'll add Nvidia too. So I'll close this one. I would just use the Jigsaw one if that's okay. It'll give someone a seizure on a vast day, probably. But it's in line with what most other heat maps look like these days. So I like the Jigsaw one because that's what I'm familiar with. I'm sure Bookmap is thrilled. Well, it's not as good as Bookmaps, but yeah, it is a big because really the way to look at this sort of stuff that was available to people before was Bookmap. There was kind of a wonky way that you get it and everything, and like I think that you could get it through Thinkorswim and Bookmap and everything. Like that's why I think this is a big deal. This isn't the first time that you could get this data. For sure, this isn't the first time that you could get this data, but for $70 a month and the software is basically free, that's a big change, right? That's a big change. And so I really think that this DX feed makes this kind of data a routine thing for a stock trader. And if you're a stock trader and you're trading like a $10,000 account, which is the minimum that you're going to need in order to, get around the pattern day trading rule, I think that $70 a month is trivial, right? And so, in my opinion, if you are a dedicated stock day trader, I don't see why you wouldn't get this set up and watch the order flow. And you can load them on the regular charts too. Like just loading up NinjaTrader chart with my cumulative delta that you get from speculatorseth.com. That's no, I thought that the pattern day trader rule was 10K. I'm not a stock trader. Let's see here. Let's look that up. Maybe it is 25K. Here's the article on it from FINRA. Okay, you're right. 25,000. So if you're trading a $25,000 account, I think $70 a month probably is not a big deal for you. You're actively trading it every day, right? Wow. Well, when you look at this on Apple, so I think we can increase our interval here to maybe 5. Another thing is we do want the delta. So here's the thing is that if you look at the delta that it's doing, actually let's compare because I haven't compared it with NinjaTraders or with mine in Jigsaw. It probably won't matter on Apple though, so it's probably not even worth pulling up. So what happens is if you have a spread, volume will come in between the best bid and ask. So how do you categorize it? Is it a bid or is it an ask? And presumably there should be a level 2 change for every market order that comes through. So it's not that there was not any volume being bid or asked there. It's that the feeds are out of sync. So what I have to do is if I get something that happens in between the best bid and ask, I have to go back and match it up with the actual order. And then there's some other rules if it can't do that, right? So my algorithm does categorize more volume, and it's about 10% volume difference. So it's questionable how much it's going to help you, but it is more accurate. And it was a lot of work. I was really proud of it. I was quite proud of what I put together, actually. So if you have the speculator Sept indicators, or you have NinjaTrader and you haven't tried them out, go and try them out and put it on them, and put it on a stock that's, you know, got that's got a bit of a spread, and compare my cumulative delta to like the NinjaTrader cumulative delta. But you can see, you know, now I can tell a little bit better. And actually, if I want to disconnect these so that I can see here, that's a little bit better, right? Now I can see what they're doing here a little bit better. Although it looks like I'm not getting cumulative deltas since then. Oh, what's with that? It's basically doing that since I opened this chart up, actually. You could also add these columns too. They could be useful, right? For some reason, it's not giving me volume data over here in this. Yeah, that's more than 300K lots. Yeah, and that's an Apple, though. Like, think about that. You had $1 million, you threw it into the market all at once. Would you have an impact on the market? Yeah, you would. Would be teeny, but it would be measurable, right? Now imagine you're going into these meme stocks that have a spread and very little liquidity being offered on it, and you throw $2 million into it, right? Because that's what these kids are doing. Does it move the market? Yeah, it does. It does. And then, of course, all of the hedge funds get involved in everything. It's just the biggest misconception I see among retail traders is how much money it takes to move a market. It's a lot less than they think it is. Like, I think most retail traders would tell you, oh, it would take millions of dollars to make Apple move in any meaningful way. A few $100K. I'm going to close this because I'm not as interested in the depth map. I am. This one is really interesting, but let's switch this over to AMD because AMD is super popular right now. How much would it take to move BLK by 1%? Well, okay, so I think that if we wanted to do something like that, we'd probably want to use our formula, right? Let me see here. Oh, that's BlackRock. Good grief, actually. Well, so what is the ATR on this? What's the average true range on BlackRock? 19. Okay, so you're talking about something that moves 2% per day. So you want to move it 50% of the average volatility a day. That would probably take a lot of volume. So now I'll come over here to Yahoo. JVSD would probably be even worse, wouldn't it? Okay. So what is the average volume on BlackRock? Average volume 692,000. Okay. So what we want to do then is we want to say, I need a pen here. Hold on. No, I'll use the square root law to calculate it. Okay. So we're saying we want it to move. So it's 19. I don't like that color. This one. No, not that. Well, it needs to be bigger for starters. It needs to be this. It needs to be yellow, and it needs to be this one. Okay. So it'll be 19 times, let's say 0.5 times the square root of x over 600, let's say 700,000. Right? Equals 8. Essentially is what we're trying to solve, right? So first thing is we do 8 divided by 19. Right? Oh wait, I should have just done it as equal. So it's not going to be quite 0.5, right? It's going to be like 0.45, 0.42. Okay. 0.42 divided by 0.5, right? So 0.84. So 0.84 equals the square root of x over this big blah 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 blah. So then we do the square. Do we square both sides, right? So we'll do 0.84 times 0.84. Okay. So 0.7056 over 700,000. Or no, wait, times 700,000 equals x. Okay. So times 700,000. 493. 493 lots. 493, 920. 920. Times the share price, which is 600. Well, 674. So to move BlackRock 1%, it would probably take 300 million. You know what though? There are funds out there that are that big. I think the biggest one that I saw was like in the billions. I think there was some that were 6 billion, right? So are there funds out there that could move BlackRock 1%? Actually, yes, there are. Wait, how many shares outstanding are there though? Okay, what is the float? Where's the float? I have to come up to like what? Statistics? Trailing PE, blah, 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 blah. Profit margin, share statistics. Shares outstanding 150 million. No, there's not enough float to move it that much. Yeah. Isn't the square root law part of Kyle's model? Well, so not quite. So actually, no. So Kyle's model actually assumes linear impact. So Kyle's model is kind of a more specific application. Actually, you're such a dick. That's funny. Is BlackRock like the biggest one of that sort? It may be. That's interesting that it's the percentage, the amount of volume. That's weird. That fund basically trades like 4 times its float every day. That's nuts. There's pension funds in the order of trillions. Yeah, I bet. I mean, that's if there's a number 2 thing that I think we underestimate, it's that we underestimate how much money there actually is out there to do stuff. You had any key takeaways from the ECB? Well, so I thought that what she said during the press conference was about what I would have expected. But what I do see from the market is that the market seemed to take her as more dovish than expected. But like, the market has been doing this a lot, right? Like, remember the last Federal Reserve meeting, they read it as more dovish than anticipated. And then Powell came out a few days late, the next week and was like, no, like, you didn't hear me. Sell it all. This is, like, you're too high. And then we had this big decline in the market, right? So yeah, no, most of the funds that I remember looking at were in the tens of millions in terms of like their credit limit, at least. Because what I had to do and what kind of first triggered me off onto this sort of stuff was that we had risk control systems then, and sometimes they were going to be performing a block buying or selling operation. It was a buy. So sometimes they were doing a block buy operation on a specific day, and their credit limits would need to be modified, and that had to be done by hand. And so that's kind of how I knew how big the funds were. I could see all of their things. You know what's the most interesting thing about that? Some content. This should be a TikTok or something. But if there's one thing that I learned from watching that, because what would happen is they'd be like, here's a thing that's happening. Or we need to change this client's credit limit. And I'd be like, okay. So then I would pay attention. What are they doing? I'd come in the next day and see what their position was. And every time it would be up. Like literally every time there was a move. When they did one of those, it moved. And very often there would be another move several days later. And it was like clockwork. It was so insane. It was just crazy how good these hedge funds were sometimes, right? But the key takeaway here was it was never a company I'd ever heard of before. Like, these funds were names that I had never heard of before, and the companies that they were buying were companies that I had never heard of before. All of those things that it's like all of a sudden it shows up on everybody's watch list and you'd never heard of them before. It was always like that. Stock traders always want to go to the most popular stuff. Like, if I was scalping, yeah, sure. Apple, AMD, probably good places to go. But if I'm like swing trading or, doing the speculation that most retail traders are trying to do, even if it's kind of like something maybe you'll hold for a few years, but you're kind of playing more the asset manager role, right? And everybody wants to go into the most popular tech stocks. Everybody goes and buys Tesla. No, guys, go and look for things that nobody's heard of before. You don't want a teeny tiny company that's speculative necessarily, but they're often companies that in normal circumstances people aren't that interested in. I always thought that was really interesting. And I think that it was at that time, I think maybe some of what I picked up during that time of my life was maybe influenced a lot by raving too. I know that sounds really like, how would raving have anything to do with the stock market? But here's the thing. If I look at what is the world like today compared to what it was like 10 years ago when I was working at the bank, like what changed? The biggest thing that changed in my mind is that the world is obsessed with the mainstream now. Everybody wants to know what's popular. Everybody wants to know what the trend is. What's the biggest stock? Who's the biggest star? Who's the biggest company? Etc. 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 And it's really sad because you got that crap from television. The reason that the internet was cool was because it was underground. It brought the underground to your fingertips. All of a sudden, if there was this party going off somewhere back in the 90s, you had to be in the know. You had to know somebody that knew, and then you'd go and you'd call a certain phone number, and they'd lead you on a chase somewhere to get to where you had to go, and you had to put effort into it. It didn't come to you. You had to find it, and the internet brought the underground to your fingertips. So if you were searching on a subject, you still had to go out and find it, but it could be found. And that's what made the internet cool. And in the last 10 years, it was like, no, that's not cool. We don't make money off of that. We don't want the underground. We don't want minority opinions. We don't want people to be talking about crazy conspiracy theories or anything like that, because what happened was the underground became too powerful. And so the power brokers at the big tech companies basically started to squash it. It's sad. And so I see that attitude reflected in how retail traders want to trade. And I say, go underground. The information that you're looking for, the things that you want to know, to like the trading strategies that you want to take, and the stocks that are really gonna bring you profits and so forth, they're usually going to be hard to find. You want to look for things that like other people aren't going to look for because it's counter the conventional wisdom or is too difficult. Like that's what we do here on this channel, right? Everything that I'm teaching you, it's not like the information's not out there. In fact, it's very well known by the industry. It's just that retail traders don't ever talk about it because to retail traders, it's too hard. So they don't want to look at it. It's too complicated to them, right? Go underground. I'm going. You ever heard that Jamiroquai song? That's one of my favorite songs. Came out on the Godzilla album. It's good stuff. Well, let's see here. Kyle, I just Googled biggest pension funds and U.S. Social Security is 2.6 trillion. Sure, they don't invest in stocks, but Finland's oil pensions do, and they are worth 1 trillion. U.S. is more specifically Federal Old Age and Survivors Insurance Trust Fund. Yeah. Yeah, and our clients weren't really pension funds. Maybe we did have pension fund clients and they were just under a different arm. No, actually, I think that's different. I think that when you were at, so our clients were mostly hedge funds. I think that if we were interacting with mutual funds or pension funds, that it was more in an advisory capacity, and that would probably be more like asset wealth management that would be working with those guys. So I don't remember ever seeing pension funds. I remember there was hedge funds that were like in the billions, but like they had like, you can go and you can search for the numbers. I think that they had 3 trillion under management at the time. Goldman did. But they periodically release numbers on that. I think that last time I checked, it was like 6 trillion. We used to do this thing. We used to have this game where on big volume days, like on the day of the Russell rebalance, for instance, to predict how much credit would be required to execute all of the transactions. And we would all try and predict it. And I actually had an idea. I was like, well, here's how I would go about predicting it and everything. And they're like, well, that's basically how we do it. I was like, oh, well, that's not fun. I'm not going to bother then. but they needed work. Their estimate wasn't accurate enough. They still get outliers sometimes that beat their expectations. Well, the treasuries we're kind of moving down here, and they're starting to move back up towards that kind of like 116.09 range. But I continue to see flattening. The 5-year is not coming back up as strongly as the 30 and the 10 are. So, ever had the pleasure of dealing with the MI? No, don't think so. You know, like, so what was this fund, this family fund that blew up the market last year? Archegos. It's the one that there's a proper way to say it, but the way that I want to say it based on the reading is completely wrong. But like, they all had names like that. Doubletree Capital. That's what's his name. Yeah, Bill Huang's fund. But then Doubletree Capital, that's the Bond Kings fund, right? They're always names like that. I always kind of wonder where do these people come up with their names from? But I wish I could go back, man. Like, it was kind of funny. Like, I learned a lot at Goldman, but it also held me back from learning certain things. And when I was on my own, I really started to get into it, and then all of a sudden I knew, like, when I kind of knew who's who and what's going on, I was like, oh, dude, Seth, you were close to some big stuff, actually. Didn't even really realize it. Like the block traders, they shared a lot of this in empirical study with me. They said, well, you go and you read studies. That's how I learned it. I learned it in school. I was like, really? You learned it in school? And they even shared with me the you know, like optimal execution stuff. And I remember reading the study, and it was like, well, okay, if it's going to be going your way, you actually want to execute most of it at the end, and but otherwise you want to execute most of it at the beginning, and that whole thing. And I read the study, and I was like, okay, it doesn't seem like, I don't know. It's kind of interesting. There was some math in there that looks a little confusing. I didn't understand why it was significant. I didn't understand it at all. Oh, really? The best ones, Blackstone and BlackRock. The guy left and named his fund identical to his employer. Yeah. You know what's interesting about all of that stuff is there is a really strong push from a group of people online. I don't know. I really don't know where it comes from, but you'll see creators on TikTok jumping on board this all the time, where they try and fearmonger around BlackRock and well, all the other, what's the other one that they've got that has Aladdin? Who are they? The other big fund manager, Vanguard. Yeah, no, it's not. Vanguard doesn't own Aladdin, is it? Anyways, it's funny because when you read about Aladdin, if you understand all of the market microstructure sort of stuff, basically what it's doing is it's sorting out what are the rebalancings that it needs to do and what are the impacts that it will have on the market so that it knows how to manage its funds in real time. That's what Aladdin is really about. And everybody fearmongers about it, like, is this robot controlling the world? Oh, it's so ridiculous. Going back to Black Bulls, I think it goes as follows. Big hedging fund needs to rebalance. Stocks selling 30 million. Bank says price will be 155 and then transact via the pool. The bank is now long from providing buying liquidity to hedge fund, and now it proceeds to sell the lot to the stock market at 155.50. Yes, except for that the other side of the transaction is usually not the bank. They are usually able to find counterparties in the black pool. And many of those counterparties are just liquidity providers that specialize in dealing with block orders, right? Because the market microstructure used to be that if you were a big guy, you'd go and you'd call this block seller and you'd buy this block seller, and then you couldn't get any of, still had trouble, then you'd go directly to the market, that sort of a thing, right? So there's these big block people that, they're providing liquidity and they already own a big chunk of it anyways. So it's not necessarily that they're transacting with the bank. Jeez. Well, we're getting close to the end here. Oh, so let me link you guys to that video. You go watch it again. Because we really want that video to do well. Oh, by the way, I need to add something into the title of it. Let's do that. Yep, he brought us price difference from 155.50 to 155. Yeah, if you want to transact with the bank, then you would just block sell. Oh, we didn't get the, yeah, they're even telling me, hey Sept, can you add that into the description? Oh my gosh, it already has 43 views. Oh my gosh, guys, wow. This is huge. Do you know? No, I don't. Why did you ask me about that one in particular? I'm starting to figure you out, actually. So here's what happened yesterday. So a few days, sometime last week, actually was like, well, if you want to learn about teamwork, because we were talking about teamwork, you should read The Anguish of Central Banking, which was a speech by a former member of the Federal Reserve that he put out just after he left the Federal Reserve, essentially. Okay, so I'm looking at this, to read about teamwork, and I think that he just wanted me to read it, because I don't think it had anything to do with teamwork whatsoever. It was a really interesting speech though, because it was basically like, here's why inflation is so difficult to tackle, right? And he went through the whole history of things since the Great Depression and all of the things that the government does that basically end up being inflationary, right? And it was really funny because I was like, wow, this is exactly what's going on today. This is exactly what's going on today. And I think that's why I actually wanted me to read it, because I don't know what it was about teamwork. Although I guess I could kind of say there was some teamwork in there, because kind of the end gist of it was that central bankers and government will have to work together, and people all kind of have a part in tackling inflation. And if it just turns into it's the central bank needs to tackle inflation and they don't have the will to do it, then you won't get it done. And in the end, that is kind of what happened. Was different policymakers got in, they were more fiscally responsible, they focused more on supply, and Volcker did his thing, and that's how they were finally able to get things under control. Let's see here. I had a bud who was in the market maker side, and after every deal with MIT, he would say most cluelessly stupid smart people. Right. Well, so there's one book on my, after I think, well, okay. So I have my book that I'm reading right now. And then after that, I'm reading Bond Market Calculations. And then after that, I'm reading a book about machine learning. And then after that, I want to get back to More Money Than God, because I'm told that they've gone back and forth from doing quantitative stuff to otherwise. I think it's going to shift again. Now that I understand so much more about this stuff, it seems to me like there is a lot of room, particularly in the portfolio optimization space, largely because there's like modern portfolio theory, which is kind of wrong. And so there's all of these people out there working off of a way of managing their portfolio that has some serious flaws in it to begin with. And the smarter statistical people that are utilizing machine learning especially are able to take advantage of that. But I think at some point people will figure that out, and the edge in managing a portfolio will probably go away. And at that point, I think that these people may return to what we're doing, which is you've got to know something, right? And so I could totally see that with this, when you say MIT, is that you'd have a bunch of quants that think that you don't actually need to know anything, right? I can totally see that happening. Okay, so I put that in the title. Oh, okay, cool. So DXViewed wants me to switch after today. So we'll keep this up for, well, I don't think that we need to have all of these up, right? I mean, that's a lot. I think that we should still have the S&P 500 up, but let's just keep up Apple here and for a month and see, you know, or we can switch to whatever is the meme stock that day, right? And we'll see if there are people out there interested in watching the order flow for stocks. Yep, that's exactly how it was explained. They have their computers and spreadsheets and think you don't know anything outside what the black box says. Yeah. Well, the thing that shocks me about the quant world is that they continually seem to misjudge other people's ability to figure it out too, right? And so they think they've got something in that it will continue to provide money forever, and then it stops. I think the thing that has really separated out the firms that really had long-term success, like Renaissance Capital, has been their ability to protect their current edges and continue to find new edges in the market, right? I think that's what really does it for Renaissance. Because these other guys, it's like they'll have something that works and then there's a big blow up, right? There's a big blow up. And gotcha. Okay, so Andre's saying now that tomorrow I'll have to move from my test account to a production account because you have to keep the information about everybody. So that's okay. We'll do that. Good deal. And we'll do it for a month, and then based on how the stream does in a month, we'll determine if we want to pay the data every month. I think that'll be a good test. And we'll see. You know, I really think that my indicator at speculatorsset.com is kind of a cool thing. So I hope that picks up too. But man, the video already has 54 views. That is before the end of the stream. That is insane, because usually it's only like a dozen, and like some of my videos have been trending to like 100 views in the day. This is probably going to be one of, if not the best performing video on my channel. Isn't that exciting? Did something happen with crude oil inventories? Oh, well, there is natural gas. I didn't hear anything about it. I forgot that I had my news squawk off, but looks like there was a draw. Well, let's see where we're at tomorrow. I don't know. I feel like now is not the best place for big speculations, especially not in the oil market. So I'm just going to kind of let them sort it out. Guys, I got to get going. So I will see you tomorrow. So think about which stocks you want to watch. Keep an eye on it. Come in here, because whatever it is, I can pull it up for you and we can watch it, right? We could even I'm not going to pull out my live account for stocks quite yet. I think if I really wanted to trade stocks, I'd want more money in there. But, well, we can certainly pull them out, and we can even put in some sim trades, right? So I will catch you guys tomorrow. In the meantime, stay excellent, team.